Ever wondered what it really takes to manage a company's fortune? Well, today we're going on a quest, a CFO's quest. We're going to follow the map and uncover the secrets of how businesses plan, control, and most importantly, grow their money. Okay, let's just jump right in with a little thought experiment. Imagine someone walks up to you and says, "Here's $1 billion. It's yours to manage for our company." Kind of terrifying, right? Where would you even begin? That exact feeling, that huge responsibility, that's the daily reality for a chief financial officer. And that's the puzzle we're going to piece together today. So here's the map for our little adventure. We're going to start with the mission, then we'll choose our destination, figure out how to navigate the path, uncover a secret weapon, and finally, we'll face the dangers that are lurking ahead. All right, every great quest needs a mission. And our first stop is understanding the science of money itself. So, what in the world is financial management anyway? At its core, financial management is basically the engine room of any business. It's this mix of art and science, all about planning and controlling a company's money to make sure it actually gets where it wants to go. So it's not just about, counting the cash in the drawer. It's about figuring out how to make that cash grow into a whole lot more. And really, this whole thing, it all boils down to two huge questions. First, procurement of funds. Where does the money come from? Are we getting it from investors? Are we taking out loans? And second, effective utilization of funds. Where is that money going? What's the smartest way to use it to create even more value? It's this constant cycle of raising money and investing it wisely that really pushes a business forward. Okay, so we've got our mission, but every quest needs a destination, a final goal. For a financial manager, what's the point of it all? Where are we trying to sail this ship? So what is the true north on that financial compass? Is it just about making as much profit as you can, as fast as you can? Or is there something bigger at play? How you answer this question, well, that gets to the very heart of what modern finance is all about. This really brings us to a fork in the road. On one path, you've got profit maximization. It's easy to measure for sure. Just look at this quarter's earnings, but it's kind of short-sighted. It doesn't really care about risk or when you get the money. Then there's the other path. Wealth maximization. This is about the long game. It's about increasing the value of the company's stock over time, which forces you to think about risk, timing, and building something that lasts. And you know what? The modern world of finance has pretty much made its choice. Like the former CEO of Coca-Cola said, at the end of the day, the real bottom line is increasing shareholder value over time. That has become the true north for pretty much every financial manager out there. All right, so we've picked our destination, wealth maximization. Awesome. But how do we actually get there? Well, the entire journey, believe it or not, comes down to making 3 and only 3 huge decisions. Think of these as the 3 main levers the CFO gets to pull. First is the investment decision. Where should we put our money to work? A new factory, R&D for a new product? Second, the financing decision. How are we going to pay for it all? Should we borrow money, or should we sell a piece of the company by issuing more stock? And finally, number 3, is the dividend decision. What do we do with the profits we make? Do we pump them back into the business to grow even bigger, or do we give them back to the owners, the shareholders? And of course, each of these big picture decisions has its own, nitty-gritty toolkit. Investment decisions use things like capital budgeting to analyze big projects. Financing decisions are all about managing the capital structure, that perfect mix of debt and equity. And dividend decisions help shape the company's policy on how much profit it holds onto for future growth. This is the real day-to-day navigation. Now, every hero on a quest needs a secret weapon, right? Some kind of magic sword or a secret map. For a financial manager, that secret weapon is an idea, an incredibly powerful one, the time value of money. The whole idea, the absolute core of it, hangs on this one simple sentence. $1 in your hand today is worth more than $1 you're promised tomorrow. Why? Well, because you can take that dollar today, invest it, and it can start earning you more money right away. Once you really get that, it changes the way you look at every single financial choice. And that simple idea unlocks something that feels like magic. Compounding. This is the process where your money literally starts making its own money. The interest you earn starts earning its own interest, and it creates this amazing snowball effect that just gets bigger and bigger over time. Okay, I know what you're thinking. That looks complicated.
But don't get hung up on the math. Seriously, just think of this formula as the secret code that unleashes the power of compounding. It lets a financial manager see into the future. You plug in how much money you have today, an interest rate, and how much time you have, and boom, it tells you what it'll be worth down the road. It's basically a financial time machine.
And guess what? This time machine works in reverse too. It's the other side of the coin, and it's called discounting. This is how you take a big pile of money you expect to get in the future and figure out exactly what it's worth in today's dollars. And that, right there, is absolutely crucial for deciding if an investment is worth making today.
Okay, we're on the home stretch of our quest, but no adventure is complete without facing a few dangers. In the world of finance, the big monster is always risk, and dealing with it is a constant, delicate balancing act. So what even is risk, really? In simple terms, it's just the chance that what you think is going to happen doesn't. If the potential returns on an investment can swing wildly up one year and crash the next, well, that's a high-risk investment. If they're pretty stable and predictable, that's low risk. Now, it turns out risk comes in two main flavors. First, there's systematic risk. This is the big stuff that affects everybody, the whole market. Think of a recession or a big change in interest rates. You can't just diversify this away. Then there's unsystematic risk. This is specific to one company or one industry. Maybe their new product is a total flop. The good news, this is the kind of risk you can reduce by, not putting all your eggs in one basket.
So if you can't get rid of that big market-wide systematic risk, what can you do? Well, you can measure it. And the tool for that job has a simple name, beta. All beta does is measure how much a single stock tends to move when the overall market moves. It's the key number for understanding the kind of risk you can't avoid. And it's actually pretty simple to understand. Think of the market itself as having a beta of exactly 1. If a stock also has a beta of 1, it moves right along with the market. If its beta is more than 1, it's more volatile. It's an aggressive stock. And if its beta is less than 1, it tends to be more stable, more of a defensive stock. CFOs use beta to build a collection of investments that has just the right amount of kick they're looking for.
And just like that, our CFO's quest comes to an end. We've seen that it's a journey of choosing the right destination, making 3 key decisions to get there, and always balancing risk. But it leaves us with one final, really important question. Not for some big company, but for you. We know every investment has risk. The real question is, what's the right balance for your future?